Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes and money and things that are interesting to you. And if you're somebody that hasn't filed, and I'm going to tell you, I know there's a lot of you out there, or if you have to amend your returns, or if you haven't gotten your refund, or you're getting letters, or you're just confused, you can give us a call in studio, 803-0930, 803-0930, star 930 on a cell phone. This hour is dedicated to you, and I got my team with me. They're all out of the office, and it's like cheating when you don't have to work 14 hours a day. I got Tiffany Fabian.
Hey there, Esther. How you
and
doing?
Christopher
Hello,
Fabian.
Esther.
That would be the husband of Tiffany. And Steve Jacobson,
Hey.
soon to be the husband of Aaron.
That's right.
Yeah.
That's
Right?
right.
We're going to get Steve
Nuptials.
married. We're getting Steve married.
Oh,
All
boy.
right. Then he'll be a happy man.
Is that true, guys? I'm looking at Chris and Tiff.
Definitely.
That's right. Chris is smart. He knows what to say. Anyway, I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. We want to hear what you have to say. Now, just to let you know, we've been doing lots of tax returns right after tax season, haven't we?
Absolutely.
Oh, my gosh.
It's like the season hasn't really ended, except for the fact that we're not working 12 hours a
And
day
we don't
anymore.
have 30 offices.
I was just doing one on Friday. It was one of my clients. She telecommutes between New York City and here, and so she emailed me her tax return, just didn't get time to do it before the deadline.
Right. So if you need help, we're open 9 to 5 Monday through Friday at egtax.com, or you can call us at 632-7886, and we will get your stuff done. Right?
Yep. You know,
right.
we always say this, but if you get the letter, bring it in. Don't pay it. I believe, Steve, you had a client on Friday that got a letter and paid it right away.
That's right. And she got a letter for 2011, and, it just so happened that when she
State
came
or
in,
federal?
For federal. And this was a couple of years ago. And so she came in this year to have her 2013s done. And we were talking, and I said, oh, Morgan Stanley, I don't remember us ever having it. Yeah, they sent me a letter about that like last year or the year before, and I just paid the bill. And I'm like, and so, because that's like, are you kidding me? You never just pay the bill. So,
And that's what we try to get people to understand is that when the IRS does the run through what has been sent to them versus what you put on your tax return, if there's any discrepancy, they don't write you this nice letter that says, gee, Steve, could you kind of tell us why this doesn't? They just disallow and send you a bill. Then it's up to you to say, wait a minute, I didn't put this in correctly. I left this out.
Yep.
And here's a cost basis on the stock. And guess what?
Right.
I don't owe you. You owe me.
The best part was she sent them like $706, and they're sending her back like $650 of that now.
Isn't that
so
great?
It's a wonderful thing. And, we fixed state for her, too, so that now New York will be happy. She only owed them like $14-15. Life is good.
Right. And that's part of what we do. And I just am trying to encourage people to feel like, think of us as your friend, not as your adversary, not as somebody that you have to pay, not as somebody that is not going to understand, because we do understand. That's exactly what we're all about, and we want to help you. So if you get those letters, don't worry. Just give EG Tax a call, and you can go to our website at egtax.com, and we will help you.
Yeah, and on Friday, Esther, I also had 2 calls about offers and compromises. We have somebody on staff who is phenomenal at doing offers and compromises.
And so
just wanna
explain
throw
what that would be, Tiff.
That's if somebody has a debt, a large IRS debt, and you don't have the money to pay it. You might have heard the advertisements on TV, we can help you settle your debt for pennies on the dollar. Well, you can propose to the IRS that I have this amount of debt, I can pay this amount of money, and it'll be resolved and set aside and settled. And Ken Schultz can help you to navigate that.
Right. And the whole thing is, in medicine, when they say if you have something that isn't right in your body, you have to haul yourself off to the doctor because you need to find out. I have to tell you, it's kind of the same in the wonderful world of taxation. If you know something's not right, you need to come in to get it double checked, because I hate to tell you this, but you know it yourself. It's very complicated, and what seems to be clear cut, if there's an exception, the answer may not be as clear cut as you think.
That's right.
Most definitely. Yep. If you have questions for us here in studio, give us a call, 803-0930, star 930 on your cell phone. And Mr. Steve, the 1-800 number?
1-800-616-9236.
He's the only one that knows it. What's it, 1-800?
616-9236. And let me give you a hint here. You just got to remember the 616, and then the other four are WBEN.
Ah, that's how it is. See, you used to work here. You don't understand. All right, let's talk about the change in IRA rollover rules. It's very important. This is something that happened that'll be effective 2015.
Yep.
But you may have a problem this year with the bank, right?
Right. They may start saying, no, you can't do that. But you can until January 1st, 2015. So you got to the end of the year. And what we're talking about is your indirect rollovers, where you get the check itself from the IRA, which then you have 60 days to move the money to another IRA.
So let's just make this clear. There was a couple in New York City who were very savvy. He was actually a tax attorney. And what they would do is they did a whole bunch of indirect rollers. They would take the money out, have the check sent to them, use it for 60 days, then roll it over, take this one out for 60 days. And basically what they were doing is they had a bunch of cash flow on these indirect rollovers. And so the tax court said, oh, no, from now on, you can only do one indirect rollover a year. So starting in 2015, that's the rule of the land. You can do as many direct rollovers as you want. In other words, if Dean Witter is sending it to M&T Bank, that's fine. If M&T Bank is sending it to Chase Manhattan IRA, that's fine. As long as the money doesn't come to the taxpayer, it's fine. That hasn't affected. But if you're going to do an indirect rollover where they send you the money and you have 60 days to put it back into another qualified IRA, that's what's been obstructed, and you can only do one a year.
Right. And we've been telling people to do the direct way for years. I mean, think about it this way. What always happens when people do an indirect rollover, normal people, not this couple, but, they get that cash in their hand and they start thinking, gee, I really could replace that car. Or, gee, the house needs some repairs done. By the time they get done with it, they spent like half the money or maybe all the money. And
Right.
guess what happens? They got to pay tax on it.
Right.
So that's why the direct rollover kind of takes that burden off of you and puts it into the bank.
And it's really easy to do. You go down to whatever financial institution you're going to be dealing with, and you say, here is my IRA information from the former place, and they basically contact the former place, and they open up the account, and they just suck it through the electronic media,
Right.
and you never get to see it.
Absolutely.
That's right.
So that's something we want to talk about. And I know that we're at the quarter of the hour, and I know we have people holding. 803-0930, 803-0930, star 930 on a cell phone. We're going to break for a short break, and we'll be right back. I'm Esther Gilius, the tax lady.
Good old days, the honest man, the restless heart, the promised land.
I have no idea what Tyler put on, but I like it. What do you got, Steve?
It's the Killers.
That is
Killer?
correct.
All right, name that tune, Steve Jacobson. I'm Esther Gilius, the tax lady from EG Tax, and we've had Jim from Lancaster holding forever. Hey, Jim, how are you? How can we help you?
I got a two-part question.
Yeah.
I received a rollover from a previous 401k that I had at a previous employer.
Okay.
I retired in 2007. They did this audit, and they said that they owed me like $575. So what I did was I did a direct rollover into the present IRA that I have. But I didn't report anything on my income tax because I didn't withdraw anything.
Right.
Did I do that correctly?
All right, so did they send you a 1099-R for that direct rollover?
No.
Okay, so as long as you didn't get the 1099-R form, if in the event that they did send it to the IRS and you didn't get it, and they send you a bill later, you can always do the tax return, an amended tax return, and show that it was a direct rollover, and it'll result in no taxes anyway. So if you didn't get the 1099-R, it should be no problem.
Okay. The other question I had is the difference between regular dividends and ordinary dividends.
You mean
Is that
qualified
the difference in the
dividends?
tax rate?
No, regular dividends are just regular dividends. You mean qualified and regular dividends, right?
Ordinary.
Ordinary, right?
Yeah, the difference between them. Why they have to be denoted separately?
Because ordinary is your total amount of dividends that you received for the year. The qualified dividends are included inside that figure, but you get a bonus. That bonus is you pay the capital gains rate on the qualified dividends,
Which is cheaper.
which is a reduced rate. It could be 0%, it could be 15%, or if you're very wealthy, it may be 20%.
It's sort of like, of those ordinary, what are qualified?
And the qualified is a special tax break.
Yeah, I kind of understood that, but I didn't quite understand how they separated them.
Okay, so let's say that you had $1,000 in ordinary dividends, and they say qualified dividends are $800. That would mean that those are dividends from a stock that you owned in a U.S. corporation for more than 6 months. And because that's the situation, they say you get a reduced tax rate on those $800. So if you don't use the special computation when you're doing your tax return, you're going to pay at whatever tax rate you're taxed at. But if you use the special, because it's qualified, the special computation, you may pay zero on that $800 as opposed to paying 20 or 25% on the $1,000.
Okay, I understand.
Okay?
Thank you very much.
You're welcome,
You're
Jim.
welcome.
So
Bye-bye.
it's basically a reward for investing in a U.S.
It's
company.
corporation, right. That's exactly right. And that's how it was set up. In other words, they're saying, we like you when you invest in U.S. corporations, and so we're going to make you pay less taxes when you invest in a U.S. corporation, and that's a good thing.
Yep.
And that's what qualified dividends are. But many people, I'm sure, that don't understand this, they say, I don't understand this, so they just tax themselves at a regular rate, and they overpay their taxes.
Well, that would be like something we help people with, having the C Corp versus an S Corp.
That's right. Which reminds us, what?
Yes, that's right. And I don't know what's going on with my mic here, but it's not picking up that well. We have a new service that we are offering people.
Well,
that
actually,
have
not a
their
new
business.
service. We're really just kind of like promoting it.
Yeah, we're expanding on it that in a way we've never done
Right.
before. It's actually called EG Tax Business Solutions. There, now I sound really great, so I don't know what you did over there, but thank you. It's called EG Tax Business Solutions, and what we're doing is, for those of you who are out there who are business owners that are in dire straits, or maybe you're starting a new business, you're not sure what direction to go in, this is for you, okay? First of all, if you're starting a new business, maybe you're not sure what kind of entity to be. Do you want to be an LLC? Do you want to be a corporation? Do you just need to be a DBA? This is what we start you off with, where we help you figure out which entity works out best for you.
Well, let me just build on that. Last night, I had a couple that came to my house because I wasn't at the office last night, and they're good clients. They came to my house. They want to buy a business.
Yep.
So they brought in 3 tax returns from the existing business that they want to buy. And we sat down in my office at home, and I looked at everything, and I said, all right, well, first of all, this business is losing gross income. See, this year, this was their gross income. This year. Do you notice how there's a downward slide? Yes. Okay, now take a look at the net profit. Do you see what the net profit is? And even when we built everything in, including depreciation and things of that nature, when we got all done in the 2012 tax year, I looked at them and I said, or 2013 tax year, I said, really, the net profit, the most you're going to look at this is $25,000. And they're going to pay well over $100,000 for the business. So, and then when we added the debt service in, for they had to borrow the money to get the business, there really wasn't anything left. So they said, oh my God, we didn't realize that, because we thought we would make $25,000 or $30,000. But, there's things like, and then the other thing I said, and have you gotten the first quarter? Because with the freezing cold weather we had.
Oh, yeah.
The first quarter just killed a lot of businesses. Yep. And you have to understand, when you're a business owner, you have to say to yourself, do I have enough deep pockets that if I have a restaurant and all my inventory's rotting in the refrigerator and I got to toss it, do I have that kind of money? And that's something else we do.
That's a huge deal. So that's the starting off point. Now, for those of you who are already in business, maybe you're in a situation where your books are a mess. You don't have any clue what your income is and what your expenses are. And come to think of it, when it comes to doing your tax return, it's like pulling teeth, because you don't know what your income and expenses are. That's the whole part of your tax return. Well, we actually are doing more bookkeeping services. We are offering our bookkeeping services to everybody out there. And for those of you who maybe have been afraid to do payroll over the years because maybe you don't quite understand it, maybe you're worried that it'll cost too much to put people on the books, well, guess what? You'll never have to deal with payroll reports again because we're also helping you with that as well. And the person who's heading it up at our office is Maria Rickard, and she's absolutely fabulous. And she wants to help you guys build your businesses better and smarter. And I know that she'll do a great job for you.
And on top of everything, it's very reasonable. Because what we want to do is we want to take business owners who can do their own bookkeeping and show them how to use QuickBooks.
That's
so
right.
they don't have to pay us to do it. We want to help them so that we do they can do as much as possible, and we partner with them.
Yep.
Yeah. And what I was going to say is, you know how when people get a letter, we say, come, call us. And I can't tell you how many times I sit down with people and they're using the wrong business entity and it costs them thousands and
Like a
thousands
C
of
corp.
dollars. So make sure you sit down, give us a call, because sometimes it's hard to undo what you've already done.
You know, and I'll tell you, to kind of build on that too, people don't understand what the difference in taxability is, you know, and to be honest with you, I see a lot of people doing these LLCs that could be they already have employees, so they already have payroll going. So they could be saving so much more by being an S corp.
Right.
And you know, there are so many people out there that just don't realize
Or
that.
a C corp. There's many businesses that are doing a C corp.
Yeah.
Which means that there's double taxation. So if your so let's say at the end of the year you pay yourself a $75,000 salary and the business is operating at a $20,000 loss. It means that you, in essence, borrowed $20,000 to pay yourself the salary. Right? And this $20,000 loss is not deductible. It adjusts the basis and carries forward. You should be an S corp.
That's right.
Plus you paid extra Social Security and Medicare tax on
That's
that
right.
money also.
That's right. And so that's part of what we see as a great help to people, and EG Tax will help you.
Or how about vice versa? Maybe the C Corp has a $40,000 profit, and C Corp pays its own taxes, and then you say, "But that's my money. I want it." You write yourself a check. Well, that's a dividend.
Yeah.
Right.
So
and
now
you pay taxes
you
on
pay
the dividend.
tax on that money too, just like the corporation, and thus the term double
Double taxation. So the corporation pays taxes on the $40,000 that's left. You write yourself a dividend, and you pay taxes on the dividend. So those are just part of things that we want to help you with EG Tax Business Solutions. And so that's something that we're kind of highlighting because we've always been doing it, but we thought it was important for people to know that that we're now doing the payroll services and the bookkeeping services, where in past years we said, no, we don't really want to do that, but we have our own staff of highly qualified accountants, and we want to help people.
And I think you brought up a good point before, too, Esther. It's the cost, too. We are offering very competitive pricing, and I can tell you, you go to a lot of these other places that are out there, they're going to charge you an arm and a leg. I mean, I hate to say it, but it's the truth. We actually offer very competitive pricing. So even if you're using somebody right now, don't hesitate to give us a call just to experiment and see what else is out there.
How much you'd save. Anyway, I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. And we thought our conversation today would kind of drift over to student loans.
Right.
Because a lot of you that are listening have kids that are in college, looking to kids that are going to college, maybe grandkids that are in college.
Or you graduated
and
you're
you're wondering
have
about your
loans.
student loans. And we thought we'd talk about student loan debt, what the interest is, and some of the options that are available to you. And a lot of people don't even know the interest rates that you're
Right.
paying for student loans.
Right.
So I looked it up. I did all my research yesterday. A direct subsidized undergraduate loan, a new one, is 3.86%.
Right. And subsidizes is one of, it's like the caviar. It's the best loan you can get, but you have to have certain income parameters to qualify for this.
And the best part about it is, while you're going to school, there's no interest on the account either.
It is the primo best
Because the
way
United
to
States
go.
Department of Education pays the interest on a direct subsidized
as
loan.
long as you're a student who's in
right.
school.
Okay, then a direct unsubsidized undergraduate loan, and again, this is where the federal government doesn't pay the freight, is also 3.86%.
Right.
A direct unsubsidized loan for a graduate is 5.41%.
So it cost a little bit more.
And a direct plus loan, this is for the parents.
I think this is hilarious, by
is
the way.
4.41%.
Oh, we should
6.41%.
We should be paying
So
more.
you think about 6.41%
That's
for
a lot of
parents to pay for student loans.
And I don't get that either, because think about it this way: if the kids aren't going to pay on it, the parents are paying on it. They probably have better credit than they do. They're probably going to make the payment. Why charge them the higher interest
Well,
rate?
and that's where the parent might want to look at a home equity loan. They might be able to get a home equity loan at 3%. They'd save 3.41% by looking at a home equity loan as opposed to a direct plus loan for the parents, right?
Yeah. I know that when my daughter started freshman year, we got a small loan for her for a parent, and I actually didn't realize the interest rate was so high. And so that's what a lot of students do, is they don't sit down and realize what the interest rate is until it's.
I was just talking to somebody in college just a little while ago, and I said, "What are you paying for student loans?" And they said, "I don't know. I just keep borrowing. I don't know what it is, but someday I'll figure it out." And that's
Wait.
the
That's the federal government, isn't it? And New York State.
and student loans and student loan people. So we thought we'd talk about student loans. If you got kids in college, there is a way out. There are ways for you to get out from under those student loans. And I will tell you, that's part of what we're doing. Since it's not tax season anymore, we're not only talking about taxes, we're talking about things that are important to you. Budgeting. We have Jeff Katz, who's going to be on doing a show on estate planning and your estate taxes. We have Dennis Kitchen's going to be on talking about general practitioner law issues. By the way, it's Dennis Kitchen's birthday today. Happy birthday, Dennis.
Happy birthday.
Happy birthday to you. And then we have our insurance guy who's going to be talking about insurance things. And so we want to talk about things that are not just tax related, but everything kind of relates to taxes.
Money.
Right? And money.
That's right.
So if there's anything that you find that you think would be interesting that you'd like to hear about, go to egtax.com and just kind of email us the items of interest, and we'll make sure that we do that on one of our upcoming shows during the off season. So as Congress unfolds the new tax laws, we'll make sure that you keep you abreast on tax laws and upcoming financial things. I'm Esther Goulias, the tax lady. We're going to take a short break for the news. We'll see you on the other side.
Ooh, I know the song.
Boy, that's so talented. Go bing, 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 bing. What is it?
Do you want to
Last
Is it-
night, she said... I don't know the
Is
artist
it?
though.
What is it, Tyler?
That is the
Back
Strokes.
Romance? Oh, the Strokes. The Strokes.
Yes.
Who are these people?
They're young.
I'm younger and hipper than you, I guess.
I guess, well, everybody's younger and hipper than me. Anyway, I'm Esther Goulias, the tax lady from EG Tax. 8030930, 8030930, star 930 in a cell phone. We kind of have a subject today about student loans, student loan interest, college costs, and all that kind of stuff. And if you're somebody that's got kids that are in college, or if you're a kid that graduated and you're now dealing with student loans, we'd love to hear what your situation is, or if you want to talk about tax issues, or if you haven't filed, or if you've gotten letters. This is the time to get some free tax advice.
And you know, there's somebody I know, Esther, and they were going to get a mortgage, and they actually looked at the amount of student loan debt they had, and they says, we don't think we're going to give you a mortgage.
Well, my gosh, it's terrible. I mean,
Yeah,
the repayment costs there. It's not a joke. You know,
Right.
when you're dealing with these kids that are just graduating from high school, they think that like this. Oh, what? So what? You're gonna get the debt. But then you graduate, and then all of a sudden they say, "Hi, student, you have to pay the debt back."
But aren't they going to live forever? I mean, when you're young, you just don't realize it. You just doesn't cross your mind, and that's why parents have to step in. And
All right. Well,
say-
first of all, do you guys know the difference between a forbearance and a deferment?
Well, deferment is when you're back in school, and at that point, they're putting the loan kind of on a hold status.
And there's no interest.
Right, and there's no interest at that
But
time.
in a forbearance,
There is interest.
they're still waiting,
Right.
Right.
but the interest is still accruing.
Interest
and
is still
and
accruing.
both of them really have to do with specific financial things.
Mm-hmm.
But when somebody's in a deferment, the interest stops. But in a forbearance, the interest is still accruing. And that's what's so scary. Accruing interest is really not good.
No.
All right,
'cause
so
it's
I thought,
compounding.
just in case you wanted to know
Well-
how much you can borrow. Yes, sir.
Just so remember, I can't talk. A note to people: don't forget, student loan interest is deductible.
Up to
Up to
$2,500.
but it helps. I mean, I remember someone that me and you used to do a TV show with, and used to, what's with these student loans? Why can't I take them off on the, But he could have. There was a parent loan, and he didn't realize he could have
Right.
taken off his son's loans. I mean, and it helps.
Yep.
It helps.
A couple of bucks
but
is
again,
better than no bucks,
Right,
you
that's
know?
right. A $2,500 deduction is wonderful.
And of
All
course,
right,
if you make too much money, they start taking it
and
away.
away.
Yeah.
Right.
Or if you do married
around
filing separate.
100,000, everything starts disappearing. All right. So how much can you borrow? If you're a dependent student, the first year an undergraduate can borrow $5,500. An independent student can borrow $9,500 with $3,500 in subsidized loans for either.
That's
All right. A second year student can borrow $6,500. And
dependent.
if it's a dependent, if it's an independent student, it's $10,500. And again, the maximum either student can have subsidized is $4,500. A third and fourth year and subsequent undergraduate can borrow $7,500 if they're a dependent, $12,500 if they're an independent, with $5,500 in subsidized interest being paid guaranteed by the federal government. All right.
I just don't understand. What if you're going to one of these private schools and they're $25, $30 a year? You have to go get private loans,
That's
right?
exactly right.
Right.
And then graduate or professionals, there is nothing for dependents. You have the maximum you can borrow is $20,500, unsubsidized only. And now the aggregate loans that you can have as a dependent is $31,000 with no more than $23,000 subsidized. And if you're an independent student, it's $57,500. If you're an undergraduate, $23,000 may be subsidized. $138,500 for a graduate or a professional student with $65,500 in subsidized.
That's a lot of bread.
It is a lot of money. It is a lot of money. And what kids don't understand is how much they're creating in debt. Now, I read an article that that people that have student loans are getting very smart because they understand that if they spend 10 years or more in the public sector working for the public good, and they're getting paid below the national average, that after 10 years their loans are forgiven.
Yep.
And so actually a lot of these very
savvy.
colleges are telling the kids, especially lawyers, go in and become a public defender or become an assistant district attorney, work for 10 years in the public sector, and your loan goes away.
That's right. That's right. There's all these qualifiers and parameters, but it's certainly something you want to look into. And Steve, what were you going to say?
And, I just thought of something else, too. What if they became a judge? That's still a state position,
But
too.
it's got to be
Income.
a lower paid position. There's a percentage based upon the excess over the poverty level that you can't
That's true.
exceed.
That's
and
true.
so that's all in there. So, but the bottom line is a lot of these attorneys who are coming out of school with $150,000, $200,000 worth of student loan interest, if they go into the public sector and serve for the 10 years, they've already got their mind set on it. Their student loans are set aside.
Yep.
So
And Chris, what were you going to say? I think you were going to
Oh,
talk
okay.
about people who are in the sector of teachers and nurses.
Right, which is
Yeah,
also a
same
public
thing.
sector job.
Right.
Like if you go into the city of Buffalo to work, and you're starting off as a beginning teacher. Again,
Right.
that's a public sector job.
And another thing, I know when I first started repaying my loans, they said to me, this is what your payment is a month. And I'm like, ay, ay, ay. And I know Steve also, his fiance, this is what your payment is. Now they've come around with income-based repayment programs. And so they look at your income and they gear your payment according to what your income is, which is much more doable than this is what your payment is. But wait a minute, I don't make that much money. How am I
Right.
going to afford my rent and my
Right.
car payment and things like that?
And I'll tell you, you brought up an amazing point during the break too, Tiff, about people filing separately now. It's going to be the new hip thing.
And that's really important too.
Yeah.
If you're somebody with student loan interest, you may be, and you probably will be, better to file married
Because of
separately,
income-based.
especially if you want to have your loan repayment looked at, because when you put your income together, they look at your joint income when they're figuring out what you can afford to repay in your student loans. So
right.
if you're somebody that's listening and you've been filing a joint return, of course they can't file separately now, can they? Because if they're married joint, they can't go to married separate.
Right.
Well, you can't amend.
No, that's what I'm saying.
But for
They can't
next
go to-
year,
Right.
rather than filing jointly, maybe you sacrifice the couple extra bucks from your tax return you would get back by filing jointly and file separately.
Right. I had a client in my tax office this year, and we called the financial aid office, and we said, now he's got a brand new wife, and collectively they're like at $130,000. By himself, he's 60. Will his student loans repayment have to go up? And they said, yes, you're better to file separately.
Right,
So that's
right.
exactly what happened.
And I did a client this year too, and she makes a lot less than her husband, and actually she had me run the numbers to see what married filing separate and joint would be, and that's because of the income based for her student loan. And she said, I got to bite the bullet. I'm going to pay $200 extra, but I'm going to save thousands.
That's right, and
in the
and the
loan.
repayment costs.
Right.
Yeah.
All right, so what are the repayment periods? First of all, upon graduation, or if you drop to less than a half-time enrollment, you have a 6-month grace period before you have to start paying your student loans back.
Right.
Generally, the repayment period starts at a 10-year repayment period, but can be up to 25 years if you financially fit that criteria. And you would who would you contact for that?
I before tax season, I dropped to a payment section of my student loans, and I called FAFSA, Sally Mae, whoever your loans are through, Fed Loans, and they are so great to work with. They really are. They said, okay, it sounds like you need to go into forbearance or deferment, and so we're going to put you in deferment for a few months, and we're going to start you back up. But it's great to work with, because I want to tell you something. If you just forget about it and don't pay your loans, it starts eating at your credit.
Yeah.
and
That's exactly
never
right.
a good
That's
thing.
exactly right, because all these things have a cause and effect.
Right.
You know, and I guess this goes true with anything. If you think you have a tax problem, find out about it, and we're a resource. If you think you have problems paying your student loans, we're here to help you. I mean, we will do the research for you because we want to help. But the last thing you should do is do nothing
Right.
and just say, "Oh well, what can they do to me?" But you're ruining your credit.
Or another way to save on student loans, apparently, is just go to jail and the governor will pay for it for you.
All right. The third thing is if you're having trouble with repaying, you may qualify to have it forgiven.
Right.
Now, let's say, God forbid, you had something horrible happen and you are unable to work, and you had gone to school, you racked up all this debt. Actually, if you're on SSI or SSD where you're unable to work, that is one of those criteria
Yep.
to have the student loans forgiven.
Right. But just remember, too, on that situation, then the loan that is forgiven is taxable.
Which is true. But I'd rather have $80,000 taxable at 10%, which is $8,000, versus having to pay $80,000 plus interest, right?
Absolutely.
If you're still in the yes.
Right. All right. So again, if you're in a situation where you really can't repay, and it's due to a physical thing, a real hardship, whether it's physical or an emotional, your debt may be able to be forgiven. And again, the attorney that we work with, Dennis Kitchen, he has been very successful in having student loans be forgiven. And you can contact Dennis Kitchen through our office, unless you guys know his phone number, because I don't know it.
631-5661.
And it's Dennis's birthday today, too, anyway. So I'm Esther Golias, the tax lady, 8030930. 8030930, star 930 on a cell phone. We're going to take a short break. We'll be on the other side with your phone calls.
He's got me on this
So,
one.
Steve,
I don't know.
I don't
who
know
it is.
this one.
I'm just too darn old. That's the way
Cracker.
it goes.
not
Cracker?
Cracker?
Yes.
cracker.
I don't know who that is.
Tomato soup, please.
They're like Red Bull crackers.
93, I believe.
Okay, then.
Whatever. I'm Esther
loans.
Gullius, the tax lady from EG Tax. We're kind of talking student loans and
Modern rock.
what a horrible situation to get yourself into. It really is. I think I wish I had every 24-year-old who's done with school or 25 or 26-year-old who has created student loan debt could get on the radio and say, don't do it. Don't do it. Go to UB. Go to ECC. Don't go to the big expensive school
Yep.
because it is really tough to get rid of. It is tough to get rid of. And we got people waiting. And we got Sky. Hi, Sky. How are you?
How are you? Good. I wanted to see if there was a number I could give my brother to contact you. My brother has a large amount of student loan debt. He is currently an unemployed teacher. He taught for 7 years in New York City, and he also, he can't find work right now. What do we do?
All right, you know what? You can call us at 632-7886. And while
discuss
we're
the
not
options.
experts in this area, we will put him with people that should be able to help him, okay?
So 632-7886.
Great.
Now, is he in New York City? Is he still in New York City, Sky?
No, he's here in Buffalo now. He's
Okay.
actually substitute teaches in Lancaster.
All right,
Right.
so have him give us a call. We'll connect him up, okay?
Great. Thank you so much.
Thank you, dear. Bye-bye. Let's
What
see.
a pretty name.
We're gonna. It is a nice name. And we got Tony in East Amherst. Hi, Tony.
Hi, Esther. My granddaughter's graduating this May, and she's got about $30,000 in debt. I want to pay off about 20 of it for her, which we had agreed to ahead of time. Now, my question is, can I pay it to the loan company without her incurring a tax? I believe that, would that be considered a gift
He's
tax?
worried about a gift tax.
Okay. See. All right. So here's the thing. You can give up to $14,000 a year per person per year without filing a gift tax return.
And
Are
there's
you
no
married,
cost to
Tony?
her.
Yeah, well, no, my wife is deceased.
Oh, I'm sorry to hear that. Okay, so you can do the gift tax return. You can give her the 30, all right, to
No cost
pay
for
for
her.
her student loans, all right, and you do the gift tax return, but it's not going to cost you anything. You don't have an estate worth more than $4.5 million, do you?
No.
So you're in good shape. It's not going to cost you anything.
So I can do it, and it isn't going to cost...
It's not going to cost anybody anything.
He's worried about her, but no.
No,
cost
a gift
her.
is free.
Okay, but
You-
I if I were to pay off more than the 14,
You can
No,
give her
you
the
can-
30.
You can do that, but what Esther's trying to tell you is there's a form that you have to file that just tells
like
the
an
IRS
accounting.
where the money is going, and it also will take away from your estate exclusion, but it's not going to cost anybody
Any
anything
money.
in taxes.
It's kind of really
Pay the
just a
20.
nuisance form. And I mean, if you had an estate of $10 million, then this would adjust your unified exclusion upon your death. But as long as your estate is under the is it
Threshold.
5.4 or 4.5?
5.4.
If your estate's under 5.4 million, under $1 million to New York State, you
now.
do this silly little gift tax return, which says to them, Tony gave $30,000 to his granddaughter, and that's it. It won't cost you anything.
And make sure that she writes off the student loan interest that's paid that year, Tony,
Right.
when she does her tax return.
okay,
Because
sounds
that'll
good.
be an advantage
Okay.
to her.
You're a wonderful grandpa. Thank you.
I believe, if I'm wrong, I'm sorry.
I know you
but
can use
pay
you
the
can pay them
school
directly and
and
it
you
doesn't
don't
go
have to
against
do-
the student
yep,
loan
yep.
thing. That's true. As a matter of fact, that is true.
Yep.
If he pays the student loan directly, that is an exception to the gift tax. So that's even better for Tony.
Yes, it is.
Okay, and we're going to go to John in Grand Island. Hi, John.
Hi, Esther. Concerning Parent Plus loans
Yeah.
that are taken out for students, my son has probably about $70,000 in student loans, 30-some thousand of which I co-signed for.
Right.
Now he's graduating, but he still hasn't secured a position. We haven't filed for deferment. I've been paying on the student loans, both the ones that I co-signed for and his that are due. So I've been making monthly payments. Is there any way to other than doing a forbearance or something like that? Is there any way to take a tax credit or anything that?
Well, this is a Parent Plus loan, and so in this particular case, because you are legally liable
But
for
he's
the
paying
loan.
both. He's paying.
Well, not on. Okay, you can't on the one that you're not co-signed with. Only the one that you're co-signed with can you use that student loan interest deduction.
But the bottom line is, have you considered, John? Do you have equity in your home?
Yes.
Have you considered like moving the debt from your Parent Plus loan to your home equity and just getting rid of the Parent Plus loan completely because it's 6.41%, which is capped at a maximum of $2,500 in student loan deductibility, and moving it to a home equity, which would be 100% deductible and half the interest rate?
No, haven't considered.
I mean, think about it, because how much is your share of the Parent Plus loan?
30.
Approximately 34,000.
All right, so you're looking at 34,000 at 6%, 6.4, that's almost 6.5%. All right, and they're going to cap the amount of interest that you're going to be able to deduct. Okay, but if you move it to a home equity, you should be able to get like a 3% home equity credit line, and it's going to be fully deductible. So you'd save almost 3.5%. So it's something you might want to do to look at. And getting yourself out from under the student loan debt.
And then, John, on the portion that's your son that you're paying, you might want to have your son look at income-based repayment program because he's not making much money, and so the payments would go down, and then you worried about not having to do forbearance or deferment, and so IBR might be a good option for that portion that's your son's.
Income-based repayment, IBR.
Income-based
repayment, right.
All right. Okay.
All right, and so he would talk to who?
You want to call and talk to the issuer, the holder of whoever your student loans are, or your son's student loans
Sally
are.
Mae.
Yep, you want to call Sally Mae and talk to them about IBR.
But you got to understand, if they're putting it in forbearance, the interest is still accruing.
Okay.
Okay?
No, I don't. Well, that's the one thing I don't want to do.
That's what he said.
I want to
Right.
get these paid off as soon as possible.
Right.
Okay.
Okay?
All right, thank you.
Thanks,
You
John.
know, one thing, too, he might want to do, depending how much equity, take out the full 70, pay off all the loans, have the son sign a loan paper with him, so the son is paying him like 2.5%, so he's making an extra 0.5% interest on it. The son,
You don't have big children yet, do you? Good.
I have one.
Do you
but-
really
but,
think?
uh,
Wait
hey,
a minute.
Wait a minute.
But I mean,
He's going to talk
I want
about
to tell
a
you
loan that his parents had
My
with him.
mother-
that when you
Hold on.
give a loan to your kid, it's like saying this is a gift.
Nope.
They're not going to pay it back.
My mother did that for me.
But you have a tough mother. No, you don't. I
What?
love Marianne.
But
Marianne's
you know
wonderful.
what though? She goes back then 30 years ago, even when interest rates were
I know.
better, she said, "You're paying more in interest than I'm making.
I know.
Pay
It's
me
true.
a little bit more."
It is true.
And I did. I paid
It
her.
is. It is true, and I'll tell you. I'll tell you, if you do the home equity, it's much lower interest rate. It's absolutely deductible. You can control it because they're going to come up with the new interest rates
Yep.
in July. So that's really tough. I think the best way to handle it, though, really, is when you have your 11th grader who's saying, "I need to go to." Wortham, or
Harvard,
or I need to
Yale.
go to something that's only $50,000 a year. That you say, you know what, 2 years at UB, 2 years at ECC, we'll transfer you to wherever.
Start here
But by
and go
gosh,
anywhere.
you just really got to. This students' loan stuff is horrible. And you people that are listening with student loans, you know it's true. And if you had it to do it all over again, unless you are born with the silver spoon in your mouth, and you got to repay these things, it becomes very serious.
Right. And, a reminder with the Parent Plus loans, you are if your son 5 years from now after college loses his job and he can't find a job, you're still responsible
true.
for his loans.
But parents are between a rock and a hard place. What are you going to
Yeah.
do? Say
Yeah.
to your kid, no, we are too cheap to help you with your
Right.
future.
No,
it's very
no.
hard.
But I'm just
Very
a reminder
hard.
to
We're going to go
parents.
back to the phones and talk to Patty in West Seneca. Hi, Patty. How can we help you?
Hi, I'm calling in regards to something you mentioned earlier. My son is graduating from a really great private college in the area.
Okay.
One of the best. He got scholarships to cover 1/3 of his costs.
Yay, good
To
for
make it
him.
brief. He took out guaranteed student loans to pay for a third, and we took a third, as you mentioned, on a home equity line of credit, which we are going to refinance.
Hey, Patty.
So he owes himself about $20,000, and he just landed a job with the Erie County.
Good.
Now, it's a job that's fairly low in pay to start, under $35,000 a year. He gets full benefit package and all that stuff. Now, you mentioned about those loans being forgiven after 10 years.
That's right.
So, what would you advise him to do? I mean, he's going to move back home, thank God, because he won't have any overhead. He does have the power then to repay those loans in full using his salary,
Patty,
while living at home.
Patty, can I read something? I hate to keep going back to IBR, but it says the 10-year public service loan forgiveness. If while you are employed full-time for a public service organization, you make 120 on-time full monthly payments under IBR, you're eligible to receive forgiveness of the remaining balance of your direct loans. So 10-year public service loan forgiveness. Is that something you were referring to?
Yeah, that's what she's talking about. Yeah. So if anybody's listening, I know we're running short, and all of a sudden all the lines are lit up. You can call EG Tax at 632-7886, and we will help you to plug in if you have kids that are graduating, got student loans. Maybe this is, rather than them looking to the private sector, maybe the smartest thing they can do is look to the public sector and get that 10-year forgiveness.
And I think it's really smart that he's moving back home so he can make those timely payments.
Right.
And fit.
Boy,
the
Patty,
criteria.
whatever you did right. Thank you, dear.
Sending him to that school was biting the bullet, but I'll tell you, it really did pay off when it came time for him to find a job, because basically they hunted him down to hire
That's
him.
great. Well, thank you for calling. But just wanted to say this, facts to consider. Community colleges, because, if you don't know if your kid's going to make it, community college, live at home, just like Patty did. Local universities and have them transfer once their major is declared. Work through college, because colleges have work programs. AP classes while you're still in high school. Those are the cheapest way to get college credits. And the last thing is college for you. Not all kids are cut out for college. Some of them should go to trade school. And plumbers make a lot of money. Electricians make a lot of money. And so we thought we'd talk about this because at EG Tax, we want to help you. And if you have questions during the week and you want information about student loans and how we can help you, we will help to steer you in the right directions. You can call EG Tax at 632-7886. We're open Monday through Friday this time of year, 9 to 5. Join us on egtax.com. And that next Saturday, Auntie Esther's on vacation. I'll be calling in from Florida. Ha, ha, ha. And I'll see you next Saturday. Have a great week. Bye-bye.